Let's now demystify the tricky topic of value-based management. It comes up often in APM, usually in Section B, and the examiner's reports say that students do poorly on this topic. That's why I've chosen it. Let's dive in. And I'd like to do three things with you here. First, let's talk about this concept of value. What does that actually mean? Then let's move on to measuring value. How can we do that? And thirdly, let's talk about an approach for implementing VBM in a company. Let's dive in. Value-based management. Well, this word value, the value that we're talking about is shareholder value. This is the main idea behind VBM, that increasing shareholder value should be the overarching objective of the company, not chasing short-term quarterly accounting profits. To help make sense of VBM, let's go back in time to the 1960s, to the 1970s, to the quote-unquote traditional era. Back in these days, have a look right here on the screen. Here is a corporate report from the 1970s. 100% financial information from the financial statements. There's no ESG, there's no corporate governance, there's no employee perspective. So back in these days, companies were using profit-based metrics solely to measure performance. Metrics like earnings per share, right? Accounting profit divided by the number of shares, or return on sales, revenue over capital employed, or maybe return on capital employed. And from your PM studies and your APM studies, you should be well aware of the pitfalls of only measuring performance with the financial KPIs. For example, short-termism. We are only chasing this year's accounting profits. Maybe we'll cut the R&D and the marketing spend if we're not on target, harming the long-term future of the business. These metrics can also be distorted from non-cash items, from accounting policies, depreciation, provisions, etc. The problems go on, and you know these problems from your studies. The bottom line is that these traditional financial KPIs are not good indicators of the future success of the company. Let's fast forward to the 1980s. Let's meet Joel Stern, working at one of the big investment banks in New York City. Joel recognized these problems that we just went over, and he also came up with a solution. He popularized the idea of measuring shareholder value and using this as our primary corporate high-level performance metric. Let's talk about measuring shareholder value now. Let's review some of the principles from financial management. And the first one is the present value, abbreviated PV, of a perpetuity. And as you probably recall, a perpetuity, a cash flow that continues into infinity. We can understand the value today of that perpetuity if we find that annual cash flow that's going to recur, and we discount it to the rate that we reinvest it at. Okay, so that's the present value of a perpetuity. It's that annual cash flow divided by the reinvestment rate, the interest rate. And this idea lets us value essentially anything, including a company. So once we understand this, we can say that the value of a company, and we're keeping things simple, this is a company with no debt, 100% equity, that's going to be equal to the present value of the future free cash flows. Those would be the cash flows from operations less the amount that needs to be reinvested every year to maintain the asset base. So all of the leftover cash after we reinvest in our machinery, in our plant, and then we discount this to the weighted average cost of capital of the company. That's the assumption that free cash is reinvested in projects that give that return based on the risk profile of the investors in that company. If we express this visually, we could then say that the value of a company in monetary terms is the present value of the future free cash flows expressed as this yellow bar. Joel Stern took this idea a bit further. He went on to say that if the company were to close its doors, if it were to go out of business, if it was announcing, we're done, there's no more going concern, the company value wouldn't drop to zero. It would drop to the market value of its assets. Now, the difference between the market value of its assets then and the current market value of the company would be this green bar right here. And we now have a new term. This would be the present value of the economic profits. Not the accounting profits, but the economic profits. The cash-like profits that are adding to shareholder wealth. So we have two ideas now that make up the value of a company. One, the market value of the underlying assets right here. And the next thing that Joel Stern said was that we can now measure this bar. And we can use the new metric, economic value added, which incorporates the market value of the assets, the concept of economic profits, the profits that are more cash-like, and the cost of capital of the company. So all three of those elements go into this new metric, economic value added. Now, that's a topic unto itself. We're not going to go into economic value added in this video. Let's keep talking about value-based management. To recap where we are with value-based management. One, we said that value-based management promotes the idea that we should measure company performance with one high-level, overarching metric that measures shareholder value. For example, EVA, economic value added. There are others, but this is a nice example. It's also in our syllabus. Now that we understand these 2 points, let's talk about implementing VBM in a company, and this is often what the exam questions center on. In order to build a discussion around value-based management, let's use this 4-step approach. You can find this in the approved learning provider textbooks. You can also find this in the model solutions of the past exams. Well, the first step is going to create a new strategy based on maximizing our shareholders' value. This could be divesting from loss-making divisions, or by focusing project selection on those projects which are maximizing future cash flows. Once we have a new strategy in place, we can define new performance targets. And let's look at a real source document from a listed company to bring this to life. Here's a snippet of a public domain document that I found in the archives of the listed pharmaceutical company Novartis. And this was a disclosure from the information about their annual general meeting. And here we see the long-term performance plan, the metrics that they will use to evaluate the performance of the CEO and the board of directors. And we see one long-term financial metric, Novartis economic value added. You might be asking, Steve, how come we don't have the EVA and the trademark symbol like we see in the exams? Well, maybe Novartis hired some consultants and they put their own spin on EVA, so this is their own version of it. I'm not sure why they're not using the trademark symbol, but it doesn't matter. So we see one metric from the financial perspective, 75% of the bonus will be coming from this driver, and long-term, 3-year forward-looking internal, financial, and innovation measures. So there's also an importance placed on R&D, developing new pharmaceutical products. After this high-level, overarching performance metric is in place, the company can then move on to determine the drivers of shareholder value. And if we look further into this document, we can see that they have done this. We also have 1-year, shorter-term objectives. And look at this. This company is using a balanced scorecard approach. So the drivers of value here, well, we need to grow financial performance. What's going to do that? Sales, operating income, that's operating profit, net profit, free cash flow. 4 drivers of value under financial. And we also need new products. We need sales in the key and emerging markets. We need to grow market share. All of this will help build shareholder value. And look at this. The whole pipeline of R&D is covered. We've got proof of concept, the beginning, filings. These are drugs that have proven themselves. Now let's see if we can launch them to the public, and then approvals. I won't read more of this to you now, but here we see the idea where the company set a single high-level measure for shareholder value, which then cascades through the company by defining the drivers of shareholder value, and KPIs can then be set at the divisional, the tactical, the operational levels as well. To recap where we are. First, we've formulated a new strategy around maximizing shareholder value. We've then defined new performance targets for the high level of the organization, drilling down into the whole company. Those targets then can be measured with financial and non-financial metrics. Now that we have these targets in place, business unit leaders and team leaders can then create their own plans at any level of the company, at tactical, at operational, so they reach their targets, which come from the value drivers, which are based on maximizing shareholder value. Moving on to the final step, here we look at the nuts and bolts of implementation. We'll need some new systems in place to capture any new information related to the new targets, and we need new HR systems in place to align our reward system with our employees' new objectives. And we can go back to the real source document to have a look at that. Let's look at the long-term performance plan. Awards here are granted in the form of equity, share-based payments. So the leadership is rewarded with equity, aligning their interests with the shareholder interests, with a 3-year performance period, so a vesting period, to foster long-term value creation. And the awards are expressed as a percentage of salary capped at 200% of target. Boy, that's a substantial reward. That would motivate me to work hard and go after my new objectives. Performance management team, there you have it. Another look at value-based management. I hope that demystified the topic. At this point, why don't you go back into your study notes, into your textbook, have a look again. Maybe it will resonate more, maybe it makes more sense.